Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Kevin Duffy and Ira Harris. Kevin is principal of Bearing Asset Management, which he co-founded in 2002, where he manages a contrarian macro-themed hedge fund with a flexible mandate. He gained notoriety during the great financial crisis by betting against stocks like New Century Financial, Fannie Mae, Bear Stearns, and Lehman Brothers. Duffy wrote extensively on the housing and credit bubble. He's got a passion for financial history and the Austrian School of Economics. And he has a newsletter called The Coffee Can Portfolio that focuses on identifying macro themes. Ira's hedge fund manager and global trader in foreign currencies, bonds, commodities, and equities for over 40 years. He served as CME director from 1997 to 2003, and also most recently. Welcome, gentlemen.
Thanks for having us.
Thanks, Richard. It's as usual. This is this is my hobby.
Great. I thought we begin, Kevin, with your views as a generalist. What is your current view on the global economy and the financial markets at a high level, and maybe from an Austrian School of Economics approach? What is happening?
Okay, well, there's an awful lot in there, and I guess the first thing is we have to kind of step back over the last couple of years and what we've gone through, and maybe even before that, we've experienced really going back, at least to the tech bubble, a series of crises, and the government has responded to those by trying to stimulate their way out of it. And so this time, we had the tech bubble and a response, fairly small response. I think the Fed's balance sheet was up 20% at the most year over year. And then we got the credit bubble, and we got a massive response. And then we got this COVID crisis and another massive response. And from an Austrian perspective, we would expect that the stimulus is causing problems, is causing trouble, and yet we haven't seen this. We've seen stocks rally, we've seen margin debt go up, we've seen everything rise, and so on the surface everything looks okay, but then beneath the surface we see some different things like CPI up 6% and the highest rate since in 31 years. We see supply chains broken, and we see the labor, 5 million jobs going unfilled. And we also have seen over really since mid February, there's been sort of a peak in the broad market, especially stocks that were in the Cathie Wood funds, some of these innovative, disruptive stocks. They've really been sort of treading water and even going lower. And so you've got this kind of breakdown that's going on below the surface. But I think that we have this sort of overstimulated economy, and that's probably the next shoe to drop, is that something is wrong. Something is sort of rotten in Denmark right now with the stimulus.
And do you see parallels in financial history, given your background in financial history?
Well, it's always different, and there are always parallels. And I think so I try not to. I'm definitely a student of history, but I also I realize that things are very different this time. So I mean, we do see certainly parallels in terms of speculative episodes. This is what we've really. What's happened is the Fed, and it's not just the latest stimulus by the Fed, But this pattern that's happened over the last 20 years or so is reinforcing this speculation. It's kind of a knee-jerk reaction now. And so we see things like margin debt. Margin debt since the bottom in March of last year has gone up 95%. It's now about 4% of GDP. And we saw this is greater. These are at record levels, but we saw margin debt was during the tech bubble got up to 3% of GDP, and during the credit bubble got up to 2.9% of GDP. So I think the parallels that we see are definitely the retail investor going all in. That's something that we've seen before, whether it's really 2000 or maybe even the late 1920s. But this stimulus that we've seen with the economy and the massive amount of debt and the money printing, I don't think we've ever seen anything quite like this.
Interesting. And your thoughts, Ira?
Oh, yeah. I mean, it's all right, and it drives. I'm not. I certainly have an Austrian bent to me, thanks to a lot of really great professors I had in graduate school. So pay attention to it. So everything that Kevin talks about, I absolutely agree with. And I do read a lot of history. It's not that I don't want it to repeat itself. I mean, it's funny that we're sitting here talking. I had a dermatologist appointment today, so I always bring stuff to read. So I pick up this morning, and I'm leaving the house, Schumpeter's essays. And it's got great essays on inflation and how to beat it. So that's what I sit and read. And I'm not looking for a redo. I'm looking to understand what came before, what did they miss, what am I supposed to miss here, and how do I put it into some type of operative way to make a profit in trading? Because that's ultimately what my job is and what my business is and what I've been doing for 44 years. So I'm always looking and searching, and we have never been here before. And when I hear people talk about, well, they go back and they look, yeah, I've read Meltzer's book on the Fed and his chapters on what took place from 42 to 51 anyway, I'm on the Financial Repression Authority. So the massive financial repression, and then I think Carmen Reinhardt's work on that period and discussing financial repression is second to none as to understanding it, because somebody policy-wise is always going to pay the price. And we know who's paid the price for the last, 14 years already, 15 years? Oh, from the subprime crisis that our esteemed Fed chair maintained was contained and nothing to worry about. And it's savers, and every time they try to lift savers, then the effect on asset prices across various assets from people who are loading up because there's really, where are you going to put your money? You have to go out and you got to buy, for those who have enough money, they buy equities, they buy antique cars, they buy real estate, they buy artwork. We can go through a whole litany, but then when the money starts to roll back a little bit, the world we find out, as Buffett would say, who's been swimming naked? Well, there's a lot of people swimming naked because they've taken on so much debt. And I think Kevin and I would find great agreement there. And I think it's a problem now, as I blogged about Sunday night. The Fed has a real problem here. Well, the world has a real problem. And, again, citing the data that Gillian Tett cited in that wonderful FT article, even though it was all based on the Institute of International Finance, that global debt had grown to 296 trillion. That's 296 trillion. And as they cited, it grew 10%, 26 trillion in the second quarter of this year alone. Well, that debt will either be restructured away, haircutted away, or the interest will be paid. But the problem for the world is so much of that debt is dollar based because of what the Fed has done for 13, 14 years with interest rates and the ubiquitousness of the dollar because of its reserve currency status. There is so much dollar denominated debt. And when you live in, pick your country, what do you think the pain is going on in Turkey right now as the Turkish lira is getting beat to hell every day? And we're at where we closing out today? We're over 10 lira to the dollar now. The debt burden on these people who are borrowed in dollars, and a lot of them are dollar denominated debt, is, forget about the low cost of dollar borrowing. It is now exploded, just like what happened in 2015 in January in Switzerland, when so many people in Eastern Europe were borrowed in Swiss francs. Why? Because so many of the mortgage originators were pushing people to borrow in Swiss, because the Swiss franc, of course, was the euro Swiss peg was at 120, and interest rates in Switzerland were so low that it made sense until it didn't, to take out Swiss franc mortgages. But when the debt has to be repaid, it is onerous. And I'll tell you what, if the dollar goes too much higher here, the pain is going to become very real, not just for emerging markets. There's all kinds of people who are borrowed. That takes Europeans too, who may have dollar debt, although the debt is so cheap in Europe that you'd be silly to be denominated in dollars unless you thought the dollar was going down. But that, of course, isn't happening. So the more pressure that Christine Lagarde puts downward pressure on the euro as she talks the euro down, which she does by sustaining lower for longer, that puts the Fed and the U.S. Treasury in a very difficult position. And yes, I know, I'm very aware the dollar is the bailiwick of the U.S. Treasury, but it's been the Fed policies that has really brought it much more front and center and made this a difficult situation. So, as I push, they need to hold the G7 and agree to everybody taper immediately to zero, and then let's see what the market reaction is. And then if you have to start raising rates, start raising rates. But you cannot let the United States stand out there alone, because the dollar will go to levels that will really cause some pain.
What are your thoughts on that, Kevin, on the U.S. dollar denominated debt? Do you see the U.S. dollar continuing its strength in a trend?
Well, I don't really have much of an opinion on the kind of the short-term moves of the different currencies. I'm kind of looking at it from 10,000 feet, and I think we're in kind of this great monetary experiment, and I think it's an experiment that ends badly, and it will ultimately mean the destruction of fiat currencies, and they're going to be replaced with something. So, as an investor, I have to be aware of that. I don't know. I think the odds of it happening are a lot greater than what is discounted in the market right now. And so I'm just focused on protect myself from that in the future, and just make sure I'm not holding a lot of cash. And as a portfolio manager, we want to hold reserves because we feel like every 5 or 10 years there's going to be there are going to be lots of opportunities that come along, aka an actual bear market. So the question is, how do you hold if you don't want to hold cash? Then what do you hold? So right now, we're just holding precious metals. But I guess that's the way I really look at it.
In your newsletter, The Coffee Can Portfolio, you mentioned you focus on identifying key themes. Can you relate some of those themes and some potential actionable investment type of ideas?
Well, I try to focus on the positives and the negatives. And so, again, kind of the 10,000 foot view up, I think, what are some of the big mega trends out there. One is the expanding middle class in China. I think you're going to see right now there are something like 400 million Chinese in the middle class. In 5 years or so, it's going to be something like 600 million. So I think, we have to be aware of that. Of course, as a contrarian, I like the fact that there's a lot of negative news that's come out of China. And so you've got a big wall of worry. So that's one mega trend. I think the intersection of genetics and data is happening. I think that's going to absolutely transform healthcare over the next 10, 20 years. And that happens to fit nicely with the fastest growing demographic by far is the over 65, not just in the US, but around the world. So that's another positive trend. The digital revolution will continue. Those are, to me, those are kind of the big three positive mega trends. And the digital revolution is really all about decentralization. That's positive. That's a real positive that we see. On the negative side, you have the centralization of government. And, we're going to, I think if I'm looking out real long term, like maybe over the next 50, 100, 200 years, I think we're going to see government diminish, but it's going to get bigger before that happens. I think it will hit a brick wall of reality, and there are going to be some shocks. So, part of that is let's say, you're starting to see some cracks in this growth in government, which has been certainly the trend over my lifetime. You can set your watch on it. But you're starting to see some cracks in the U.S. foreign policy, the failure in Afghanistan, certainly. So there are limits. I think you're going to see these cracks in monetary policy. So those are some of the negative trends, and how do we protect ourselves? How do we translate that into investment advice? And so we're long gold. Gold stocks is definitely an area that is interesting because really the miners have gotten religion. They went through a bear market, a really severe bear market from 2011 to 2015, and they got religion. And so right now, with gold at $1,850 an ounce, I think a lot of these managements now are very conservative, and they're gushing cash right now. These stocks, they actually look like value stocks. And so you've got a value stock with some optionality. If the currency implodes, you definitely have optionality in gold. So there are ways of taking advantage of both the positive trends and the negative trends. I can go on as long as you want, but those are just a few ideas I throw out.
Interesting. And your thoughts, Ira?
Well, I'm certainly been bullish on the map. Not as a standing bull all the time. Listen, the only thing to me that really corrects gold is, of course, the real effective yields, not nominal yields, and that's been a historical case. But I agree with Kevin. But listen, Richard, as I've said on this show many times, people go, "Oh, you're a gold bug." I said, "No, I'm absolutely not a gold bug. Nothing would make me happy to see gold at $41." But my snarky retort is, "Well, you must be a fiat currency bug." And if you're a fiat currency bug, I have problems with that because really, look around. Not such a good way to be. And I think his point is very well. Where is this going to go? I don't know. But I will tell you, and I've said it before, and I'll say it again, that when the Chinese, the People's Bank of China and the Chinese hierarchy talks about a central bank digital coin, I think that the Chinese will, if they bring one, it will be somewhat backed by metals. And even Leo Brainerd talked about, digital coins, stable coins having a gold element to them as a possibility, as well as, they want to create these stable coins almost to mirror SDRs. Well, that, you might have commodities behind them. They become very interesting, right? I'm reading, as I look right now at Coinbase. And these are basically funds that are just going to be looking for things. So why not metals? And for the Chinese, as I've always maintained, their central bank digital coin, just to stick it to the West, because they like sticking it to the colonial. They hate their colonial past. Read Chinese history and you understand. Read Deng Xiaoping. Read Mao. They hate that period of time in the mid 1800s with the Boxer Rebellion, the Opium Wars, when they debased silver, because while everybody else was on a gold standard, China was on a silver standard. So I would expect to see a central bank digital coin backed by some proportion of gold and silver, which would really upend. And the Chinese are really good at being upenders. That's not the word I'm looking for, but they love to do that. And nothing would upset it more, because the whole Keynesian basis since for 70, 80 years has been that, of course, gold is a barbarous relic and has no place in the financial system, but that would give it a place. And that would really scare all those who take on debt and feel like there's really no cost to it, because we'll set the cost of it. That would give it an alternative and would really, I think, be a disruptor. That's the word I'm looking for. Be a disruptor to the dollar status as the world reserve currency. But the Chinese don't have enough credibility without it having backed by some semblance of some underlying precious commodity.
What are your thoughts, Kevin, on central bank digital currency?
Oh, wait. Yeah. Let me add one more thing, because Kevin talks about the miners. And I think his views are absolutely right. The miners have just been, that when they're like the telecoms. When they get too much money, they do really stupid things. And I think in order for the miners to really gain credibility with investors, they need to declare some special dividends and really reward the shareholders who have put up with their crappy management for all these years, and really do something positive for them. So that would get me to, if the miners could right some of the past wrongs, that would be a good way for them to begin.
Your thoughts, Kevin?
Thoughts on central banks and digital currencies? I think that there's certainly a problem here. There's a trust issue, and that basically the governments have they violated the trust. And so, will people trust the Central Bank of China more than they will the Federal Reserve or the Swiss National Bank? I don't know. I don't know the answer to this. And, I don't think we necessarily have to know. It's almost like watching the fireworks from the sidelines, we can enjoy the show. And we were kind of rooting for an alternative here, because we know the one right now is being abused. But there are a lot of issues here. There's a lot of abuse going on, and it's not just it's all over the world. I mean, you look at what's going on with the response to the coronavirus and vaccine mandates and lockdowns, and I mean the discrimination against people who are not vaccinated in places like Australia and Lithuania. And this is something that it's just remarkable to see the authoritarianism around the world, and how it's like a switch has been flipped. And that's a really difficult environment, because with spending your money, your private, I think privacy is something that's going to be valued in the future. And I don't know what is going to solve this problem. The market will try to solve it, but governments are to be less and less trusted, and maybe the blockchain will be a part of the solution to this. I don't know right now, but I'm just rooting for the market to just get in there, and compete. You've got 8,800 cryptocurrencies right now, all going at it, and I think that just healthy competition is healthy here for some kind of an alternative, and it's not just a monetary alternative, but privacy alternative, and we don't want governments tracking our spending, and it's when we see the draconian measures that are taking place, we realize that this is, this sort of Orwellian future is kind of here right now.
And what do you make of the current environment in terms of like supply chain disruptions, both in product and in service?
Wait,
Oh yeah, sorry, yeah, Ira, did you
we
want
come back to this? So I think that makes a very good point. I'm one who's opposed to digital money, because I think Kevin's right. And people say, and I'm not a conspiratorialist. This is not conspiratorial. Read the academic literature as to why they want to go to digital coin. Larry Summers and Rogoff and others who put it forth. And if you read what they write, it's about to curtail illicit activities, right? Because we know that $100 bills are the mainstay of drug dealers, just like the $1,000 bill, believe it or not, was for bootleggers. And I collect them for that reason, when you can find good ones. So this has been going on, but they want to digitize your money, because what they learned is the Europeans could do it, but you've noticed that the United States, meaning the Federal Reserve, has never taken us, unlike the BOJ and the ECB and the SNB and a few others, we've never gone negative, right? That has been a line that they haven't wanted to cross. And rates may go there on any given day because of the shortage of T-bill. There's all types of things that take place in the repo market, the reverse repo market, that send rates sometimes low, but we've never been officially below zero. And they know that what that will do, is, as Lacey Hunt brilliantly talks about the velocity of money and lays it out. If you were to go negative, the velocity money would probably dry up there, as people would take their money out of banks, because if there was a fee, like if there was a penalty, even Europe's short of a penalty. The banks may pay a penalty, but the depositors don't, up to a certain, only the largest depositors. So they would like to be able to have digital currency. So if things slow down, they could go to negative 5%. Yeah. And you would have to spend your money, because they would have virtual control of it, because it's not in your pocket. It's digitally and electronically in the bank, right? So Kevin's point is really well taken, and something that we need, because I'm a rabid libertarian. I believe in social safety nets, but when it comes to personal freedom, it's a very important thing. And I think that electronic and digital currency robs us of that freedom. So it's something to be very aware of going forward.
Yeah, exactly. It's, even software parameters can be set, like expiry, length of use of the money. All kinds of software can be applied, right, in that type of situation. Wanted to ask on the current environment, Kevin, in terms of the supply chain disruptions, do you see opportunities in supply chain logistics and management and supply chain sustainability services, those types of companies for opportunities to invest in?
Well, that's not an area that I've looked at specifically. I do follow the retailers, and that is a theme that I've liked. I tend to be a contrarian, and I like these simple narratives, and the crowd kind of just, looking at at something that's very simple and sort of extrapolating into the future. And so this idea that e-commerce and especially Amazon was going to put all the physical retailers out of business, that's something that I think a few years ago especially was really kind of came to a head. And I think what's happening is that that these retailers are surprisingly, I think Amazon, first of all, picked the low-hanging fruit. I think they're a lot more robust than investors give them credit. They have adopted this omni-channel model, and so they have a tremendous amount of flexibility. And what's happening is Amazon, they acquired Whole Foods, and they're becoming more of the omni-channel retailer, and so they're all sort of morphing together. And yet there's still this perception, there's this big cloud over retailers. And so if you look at retailers, these physical big box retailers, maybe on a scale of 1 to 10 in terms of value, 1 being the cheapest, I think lockdowns, they got slaughtered. I mean, they were a 1. They were about as cheap as you could possibly get. And then we got the reopening, and maybe got up to about a 3 or a 4. And then we got hit with these supply chain issues, and they went back to a 2 or a 3. Well, what's happening is you're getting the headlines right now, which is all negative, and it's just been relentless. But if you look at the numbers are surprisingly good. And this is what I like to do, is just look at the earnings releases, look at the numbers, and kind of look behind the headlines. And you see that these companies they've really held up surprisingly well. And today Walmart reported, and their inventory levels in terms of days of sales, they're about the same as they've been for the last 5 years or so. So they're not just having to draw down inventories. So you're seeing a lot of things and surprising things. In fact, the supply chains are actually hitting the online businesses harder than they are some of the physical businesses. These retailers are, they're not as dependent on the logistics, actually. So it's not quite what it appears, and I think that creates a lot of opportunity.
And your thoughts, Ira?
No, I really haven't. I wrestled with that. I think he's right. The Amazon scare for a lot of businesses. You saw it. All you do is have to look at Kroger, and I'm happy to say I've been an investor in Albertsons. So where they thought they were going to be driven out of business, they've actually done very well. I think as capitalism works, it forced them to become better managers and to deal with the online world in a way that they were able to adjust to because they were better at what they did. So I think I agree with him wholeheartedly.
Mm-hmm. And other than the precious metals, Kevin, do you have thoughts or views on other commodities, commodity sectors like agricultural commodities, base metals?
We have some exposure in fertilizer. We also I've been bullish on natural gas on the Marcellus. So oil and gas. I like the fact that there has been really underinvestment during the past decade, and there's sort of a parallel with what's going on with the gold mining industry. Is that there's this cloud right now, and there's this conservatism because they've gone through such a tough time, and so you don't see supply coming online, you don't see a lot of the crazy activity, and you're seeing that with oil and gas, and I think a lot of it has to do with ESG, the whole ESG movement, which is really taking off. And it's far more advanced in Europe than it is in the United States, but it's really starting to take off in the United States. And these oil companies are having a tremendous amount of pressure on them to not go out and look for oil, drill for oil. So that the pressure is to not only not bring on supply, but pay out dividends and to get into other areas, alternative energy alternatives. So I don't know. I think we can look out in terms of a lot of these commodities, and you're just not going to get the supply. The other thing I like is that they benefit from one of the mega trends that I talked about, which was China and the growing middle class in China. And what happens with commodities apparently is that when people move from poverty to the middle class is when they really use commodities. Okay, their consumption of commodities goes up dramatically from, I believe, if you go from $1,000 in per capita income to $20,000, that's when you get the biggest bump in commodity consumption. And so I think commodities are actually a good play on China right now, and the emerging middle class, the growing middle class in China.
Your thoughts, Ira?
Oh, this is it's the home run for me. I think the point is and this is what got us motivated last year, Richard, as you know, when Louis Gavay and I discussed this. It was in early May. And the one thing that stood out, and it still stands out, and what makes Kevin's point, I think, exactly right on, and it's really emanates out of Michael Pettis, that as China becomes more middle class and transitions from just an export monster to a much more domestic consumption, it behooves them to import, right? And nothing said it more, and it really led the way. Another part of the top-down analysis is that in the face of everybody's projections last year, the yuan rallied. Now, as the global economy slowed, every analyst that Wall Street analysts especially, talked about that the Chinese would have to depreciate the yuan, right? They were all looking for, and the yuan actually went from 7.12 down to where we are right now. It just made probably 6 or 7 year lows down here at 636 and a half last night or so. All because I think they've spent their time importing, especially stockpiling commodities. And you saw when prices really got high over the summer, that central authority in China was auctioning off stockpiles I teased some people. I said, well, how can they be auctioning stockpiles? They don't have any. But they did. They stockpiled a lot last year. And you couldn't blame the Chinese because they knew that the U.S. was trying to depreciate the dollar last year to forestall a strengthening of the dollar. So we saw the dollar swap lines opened, we saw interest rates pushed, and we saw the 120 billion a month in QE. So all things done to weaken the dollar. So the Chinese took their dollars, which were going to weaken, and bought hard assets, meaning what did they buy? They bought iron ore, they bought copper, they bought grains, everything went up, and they were very effective with it. So Kevin, I think, is right on target. And the yuan is probably one of the great indicators of Chinese desires. Now, I think the Chinese, especially in the grains, when we saw the beans and others make highs in May, and the beans have certainly sold off because the Chinese won't race everybody. And they were busy, I think, selling off some of that stockpile. But now let's watch them here. And I think if you watch the grain market with the yuan, you'll see some very interesting things as we head, because right now we're between harvests. The United States just brought in their harvest. The Brazilian and Argentina crops are just in the ground. And with where bean prices are and where the dollar is, dollar yuan, actually U.S. beans are pretty cheap for the Chinese. So I think Kevin is dead right on target. Nobody's understood. Remember, all these commodity prices went up last year while the global economy was turning down in response to COVID. And that was very intriguing to me.
And are there other ways to invest on this China theme, Kevin, either directly or indirectly? We've covered the commodity case, but like in equities, maybe out of in the U.S. or Hong Kong or China. What are your thoughts on that?
Sure. Well, there is an ETF, which is the symbol is KWEB, and so we own some of that, which really is the internet and e-commerce economy of China. It's sold off, but if you compare the big tech companies in China, they are they look quite reasonable compared to the big tech companies in the United States. So that's one way to take advantage of it. There, I'm looking in that area, but one of the things that I like is again just trying to focus on the consumer, the middle class consumer. And so there are actually retailers, that's an area that I like. And there are retailers that are doing business in China. So, you can look at obviously American companies like Starbucks and Yum China, and Nike, of course, does a lot of business, Apple. But so you've really got to go on a case-by-case basis. I mean, I'm not a fan of Nike because I'm concerned about some of these woke cultures and really what that might do to some of these companies. But we own a company called Skechers, which is the third largest athletic footwear firm in the world, and so it benefits from that trend. The China, Skechers has a huge presence in Asia. And so it has the cloud from being a retailer hanging over it, which keeps the valuation in check. And it basically has this, the US operation, which is very slow growing. There's not a whole lot of growth there. But it's got this wonderful international business and a huge presence in Asia. And I believe their Asia business is probably bigger than the US business. So, that's a nice little gem. I mean, a high quality company, I think, that's just, sort of under all this garbage is sort of covering it up, these clouds that are covering it up. So those are the types of things that we like to look for.
Mm-hmm. And your thoughts, Ira?
Again, I think those are all smart plays. And actually, I've been out of China. The last time as I've always maintained for 20 years, China was always a hard place for me because when they don't allow Google to operate freely, I was skeptical about a lot of the data that came out. Not that I was in disbelief of the Chinese story. I think the Chinese story is very real. And under Deng Xiaoping's guidance, as I keep his great phrase, practice is the sole criterion of judging truth, because he moved from the theoretical to the practical and moved China a long, long way. And I think the China story has been an amazing story in so many ways, but I've been skeptical, and I played it by being long, things in New Zealand and Australia, because they were certainly great beneficiaries of the Chinese growth miracle. But then I owned Yum, because when Yum spun off Yum China, so I really very little investment in China. I watch it closely. But I did buy Diddy when, as Kevin notes, the sell-off in tech. I thought, well, that was kind of interesting because they beat it up. But I listened to what the Chinese were really concerned about. And it wasn't that they were making money. It's just that the amount of data they were gathering, just like in the US with, because Google and Amazon and Uber and Airbnb, they're all data gatherers. And I'm a big fan of Shoshana Zuboff, who's written in highly intelligent and great criticism of what she calls the age of surveillance capitalism. She's wonderful to read, and I'm very concerned about the data. But I think that Didi, as being the Uber in China, will do very well. It's just that they will not be able to disseminate that data because China's an authoritarian government, certainly with the Communist Party in control. They don't want any competition for gathering of data. So that ties the hands of the tech companies. But I think that there's so much business there that the fall, as they were taken to the woodshed, so to speak, did provide opportunities. And I see what Kevin is talking about. And I'm actually putting my foot in just like he is, or not quite my feet, but my foot, and taking advantage of it because I do think that there's opportunity there.
Mm-hmm.
Yeah, and I would add to that that I think Ira brings up an important point that to be bullish on China is not to be bullish on the Chinese Communist Party, and I think there's also another idea that's sort of floating around that supply chains are broken, and see, this just proves that that we should turn inward here in the United States, and that we should bring manufacturing back to the U.S. and that we shouldn't trade with the Chinese, and I think that these are kind of the clouds that are overhanging China right now, which is going to create the opportunity that it does. And if you wait for these clouds to lift, well, you're going to miss out on a lot of that. But we shouldn't kid ourselves about the Chinese government. And the fact is that in a lot of respects, I don't know which government is worse, our government or their government. And they seem to be doing a lot of the same things, a lot of damaging things. And at the end of the day, we're probably going to get a global recession. And I think at the end of that, I believe that what will come out of it is the realization that we can't be really warring with each other. We can't have trade wars. That we do. Our fortunes are absolutely tied together, and so I just don't see where China turns inward and the U.S. turns inward. And at the end of the day, I think now it could be messy along the way. I mean, don't get me wrong, but I do believe that the global division of labor is going to continue to expand. And there was something else. I lost my train of thought. Sorry.
No worries. I just wanted to ask as a final question, how do you factor in an assessment of the geopolitical risks in this regard, between China and the U.S.? Does that come in, like issues over Taiwan or the semiconductor manufacturing industry in Taiwan? What are your thoughts on the geopolitical risks?
Well, there was a good. Stansbury had a conference, investing conference, and there was a panel. They had Ron Paul on the panel, and Grant Williams, and John Tamney, and Dan Ferris, and that was the question that was asked. And I thought Grant Williams gave a terrific answer to that. And he said, we have to keep in mind that the information that we're getting is being filtered through the Western media. And he spent, I believe, 20 years in Singapore and in that region, and talking to a lot of people. And he said he believes that those fears are way overblown. We're making a lot out of it, and the Taiwanese are really not concerned at all. So I think I don't profess to be an expert. I would defer to somebody like Grant Williams and just suggest that we take that with a grain of salt. But I also think that long term, mutually assured destruction is just not a viable strategy for either country. And I think we're going to get through all this. And I just don't think that the United States is really. We couldn't even deal with Afghanistan. I mean, can you imagine a military action against the Chinese, which has the second largest military in the world? It just doesn't make any sense.
Yeah.
It doesn't mean they won't try it, but I have my doubts.
Mm-hmm. And your final thoughts, Ira, on that?
Well, I've been very consistent about this. When Hong Kong was I've studied enough China. Don't have to live there. But it's always been Taiwan. It will always be Taiwan. And again, the question you have to ask yourself is, nibbles around the edges of it, are you willing to risk thermonuclear war to save Taiwan? And the answer since 1971, when Henry Kissinger stood in awe of Zhou Enlai, is absolutely not. You're not. And Taiwan's been an issue. You have to go back to the 50s. The Chinese used to fire artillery shells at the two islands in the Taiwan Straits, Quemoy and Matsu, and that would be a regular show that we're not going away. We're concerned, and we are watching, and it's where we are now. There's bluster, and as long as the bluster doesn't get too far, but when people say, well, you're going to defend it, you define for that what that means. Are you going to risk thermonuclear war to keep Taiwan independent? And you have to ask yourself that question, or any policymaker. So how far? And the Chinese know that discussion. You can't help but have that discussion, right? Because you have two belligerents who are both nuclear. Are you willing? No, I think that Kevin answers that question. Are you going to? No, because the whole concept of mutually assured destruction. So, yeah, you can put together all your allies that you want. When the Chinese decide that the question to put the question, they'll put the question. You just saw it with Hong Kong, right? And that was a 50, and all that was a 50-year agreement that was signed when in 1997, I believe, that it would be separate. But when the Chinese decide to move, they're going to move because they're rolling back what they believe are the real negative aspects of Western colonialism in China. And it's a painful process for them, and it was a painful time for them. And they don't forget that. And I think we lose sight of that at times. So before we get a little too belligerent and start, saber rattling our own, I don't think I don't think you're ready to have that discussion. And I'm a believer in Graham Allison's, Thucydides trap. Is there room for 2 powers, 3 powers, 4 powers in the world? Absolutely. It's responsible diplomacy to ensure how it takes place, and that's what we're banking on. You're not going to prohibit the rise of China, and it would be a silly thing to do. Why shouldn't China rise? Why shouldn't China be a global power? There's room, and if they are responsible, why not? And with the Chinese, and I make this point repeatedly, the Chinese don't embark on stupid incursions like we did in Afghanistan, right? They don't do it. They do it on the cheap. And you can go look what they did. I always cite this 1979, China invaded Vietnam. And that was in a response to they felt they were being encircled by the Soviet Union. I know that flies in the face of the monolith of communism. So they invaded. They thought the Soviets and Vietnamese were getting too close. for 3 weeks. I think the Chinese fired 800,000 artillery shells. They sent in troops. They bloodied the Vietnamese army pretty good. And after 3 weeks, they pulled out and said, "You get the message?" So that's the way that they do things relative to, we can't wait to send in troops and park them there for 20 years, right? The Chinese send messages in 3 weeks. They're pretty good at it. So pay attention to movements, and I think Kevin's point about the Western media is absolutely right. Absolutely right. Now the whole thing with the Uyghurs. Now, I don't know. I don't really know what's going on in Xinjiang, but I can tell you this about Xinjiang. Xinjiang is a very mineral-rich place. It's been that way. Stalin had eyes upon it, and they actually put mass troops on the border of Xinjiang, and had second thoughts about it. But the Chinese will never surrender Xinjiang. It's way too mineral rich. Now, that doesn't give them carte blanche to do what they want with the population. I'm very sensitive to concepts of labor camps, but the Chinese put themselves in labor camps in the Cultural Revolution. So before people start being bombastic and going off on this tangent and that tangent, think it through and pay attention to what the context of it is.
Yeah, can I just add something to that? I totally agree with Ira, and it kind of reminds me of the famous Bastiat quote, where goods are not allowed to cross borders, soldiers will. And so we really have a choice here. I mean, the choice is between trade, free trade, which is mutually beneficial, or we fight with each other and destroy each other. I mean, it's a pretty easy choice. And also to Ira's point about allies, we're going to have a hard time really lining up allies to fight the Chinese. They don't want to fight the Chinese. I mean, we might be able to get some, like Japan might go along with us, but for the most part, the European countries, I don't think they're going to go along with this. They would prefer to get rich and trade with the Chinese.
Mm-hmm. Well, great insight, gentlemen. How can our listeners learn more about your work? Kevin?
Sure. You can go to my website is thecoffeecanportfolio.com.
And Ira?
Well, they find Richard, I'm kind of blessed and honored, and I really appreciate the work that you do with the Financial Repression Authority. So you can find me on many blogs. Next week, we're doing the one with Jimmy Bianco. So we're advertising that, I think. And that's going to be interactive, which I think we've never done. Richard, that's a lot of work for you, and we really appreciate that. Yeah. And I don't blog as frequently as I did, but there's a lot going on, but there's not a lot going on. So Notes from Underground, it's out there. I think it's been its goal is to provide and explain the contents and nuance to so many global macro themes, and that's what we try to do and make them investable. So that's where you can find me.
Great. Thank you so much, gentlemen. Thank you.
Thank you, Kevin. Nice to meet you, and pleasure.
It was my pleasure. I really enjoyed it.
Yeah.
And, Richard, thanks for having me on.
Yeah. I will find the coffee can.
Okay.
Thank you.
Yeah.
Thanks, Richard. I'll talk to you, and we'll talk more about next week.
Yep. Okay. Awesome. Thanks, guys.
Okay.
Yeah.
Bye.
Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.